Welcome back to another edition of Strategic Targeting Podcast. I'm Rick Grant. This is the show where we take a step back from the tactical and try to look at your business in a more strategic manner. Now, to do that today, I've got a guest who's been around the mortgage servicing business for decades. He understands mortgage and servicing and default and REO management. Today, he's going to talk to us about a problem that a lot of people have seen coming for some time, but many still aren't getting ready for, and that's rising delinquencies in mortgage servicing. We'll be talking to Michael Harris right after this. Michael, it's good to have you with us. Now, I know you own Genic Asset Management, but you're a consultant. You're like head of the servicing business for BlackFin Group. Is that right?
Absolutely. And first of all, Rick, thank you very much for having me here. I really appreciate it. And yes, that's correct. I'm director of the servicing operations and offering for BlackFin Consulting Group. And it's a great partnership to be able to offer different types of, leadership-based consulting opportunities, offerings, and programs for our customers.
That's great. That's great. I know some of the guys on that team over there, and you're on with a good group. But what I want to talk to you today about is this kind of strategic imperative that you've identified. Tell us what we're talking about today.
Well, some of the things I've been talking about in the last 6 months to almost a year is just the pending increase in delinquencies, mortgage delinquencies, and defaults, and potentially foreclosures. And talking about strategically what leaders of those types of operations who manage those assets can do to be proactive, to help mitigate risk, loss, et cetera. And so one of the things that I've been saying is how you manage your operations, how you're reallocating your resources, and how you're managing your loss mitigation, most importantly, your compliance.
All right. Now, Michael, people have been talking about this since the end of COVID, that delinquencies are going to rush back in. It hasn't happened. Why do you think now is the time to get serious about this?
Well, there are a couple of things. Let's take a step back to COVID. We have seen an increase in foreclosures in the last 6 months. Many of those foreclosures have been a byproduct of those that had been started prior or during the pandemic and were a part of the moratoriums that we saw and heard about. Those foreclosures have been being released in the last 6 months. You'll see things come through quite a bit in the next 6 to 8 months as well. Again, many of those are from pre-pandemic or during the pandemic. You'll see an elongated amount in 2024 just because many are in eviction, and eviction is another issue where we have to manage and work through as well. But this is a pending issue. We have certain things going on in our economy that are precluding the opportunity for additional delinquencies, and again, all the way through defaults and foreclosures. And most importantly, what are lenders' servicing units going to do about it?
Right, because I guess when those impediments go away, those delinquencies could rush back kind of in a fury. Now, this isn't the program where we get into tactics, but I know you know all about that, Michael, and we probably should talk about that at another time on another show. But remaining strategic, what do you see as the risks to companies that don't take this seriously enough now?
The number one thing I see, Rick, is resource allocation, as I just mentioned. Allow me to elaborate. Is that much of the resources and tools and attention has been spent in the last 10 years on originations, and righteously so. Now that originations are slower because of interest rates and other factors, what are the resources within the operating unit, the servicing unit, and more importantly, the default servicing unit, as it relates to managing those delinquencies and defaults? And how are you going to reallocate those resources? What are your attempts to use third-party applications, third-party products? How are you going to manage those from a compliance perspective? And most importantly, do you have the right people in the right chairs? Again, a lot of people have not been focusing on default servicing for obvious reasons. There hasn't been a lot of default, but it is pending. I think it's very important, almost imperative, that we get in front of it. We talked about this 6 to 8 months ago in different podcasts. However, a lot of the conversations I had with those leaders and those types of units were saying, yes, I agree. It's coming. I just can't focus on it right now. But now I'm hearing more and more, and those who I talk to that are in those chairs, that this is becoming a bigger and bigger issue for them. And now they're scrambling a little bit to try to get in front of it and be prepared for it.
Well, that doesn't surprise me. And the news that came out of the New York Fed earlier, I guess it was last week, isn't going to help. They were talking about credit card debt and the staggering amount, historically high amount of debt that consumers are under now. It's just a matter of time before that pressure starts to impact their car and home payments. So,
Yes, you're absolutely right. And that combined with historically low savings rates for per household is pretty daunting. And it's not that even those two statistics, credit card debt being at all-time high and cash and savings being all-time low, it's an astronomical low. And so from that standpoint, we're so outside the swim lanes that's a little disconcerting about where we're going to go in terms of what if adjustable rates adjust, where we go if we get into any type of financial crisis moving forward to 24 and 25. Where are people going to be able to manage their mortgages?
yeah. And when things go south, it could go south fast because this is impacting millions of Americans now. All right. So, talk to us about the upside. I mean, there's got to be more to this than just reducing loss severity. What are the positive benefits that are going to come out of getting ahead of this now?
Well, so there's a couple of things. One is, what are the byproducts of what we unfortunately went through in 2007 through, say, 2011, maybe even 2012? There are a tremendous amount of advances in loss mitigation and those practices to help borrowers. And more importantly, those compliance tools managed by the government to make sure that everybody is in check and to protect borrowers. And so from that standpoint, there was a positive outcome out of that time frame. And hence why, we see some positive things going on in the mortgage lending servicing industry as we see it today. However, we can experience the same thing right now, where if we get in front of this, we can learn as we go rather than learning from our mistakes. And it's important for us to go and look at our individual processes, our individual business units, our capacities to make sure that we do the best practices, we do the problem solving now before it happens, as opposed to being reactionary. Again, as an operator, I've always been a big proponent, as most people are, to being proactive in our decision making rather than reactive.
Well, it can make a huge difference in this case going forward. We've been listening to and talking to Michael Harris. He's a partner at BlackFin Group Consultancy. Mike, thanks for being with us today.
Absolutely. I appreciate it, Rick. Nice to see you.
And thanks to all of you for joining us too.